Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money world, and today we're diving into the financials of Cohen & Steers Institutional Realty Shares Inc., a company that manages real estate investments. Let's just say this report is less about flashy growth and more about, well, you'll see. Before we jump in, if you like untangling complex financial reports and getting clear insights, smash that subscribe button. And hey, join our Discord community linked in the description below for more direct discussions on these filings. Alright, let's get down to business with the semi-annual shareholder report for Cohen & Steers Institutional Realty Shares Inc. as of June 30, 2025. This report gives us a snapshot of how the fund performed over the first half of 2025. So how did the fund do? It had a total return of 4.51%. Now this sounds okay, but let's look at the benchmarks. The linked index, which is basically a real estate tracking index, returned 1.80%. That means Cohen & Steers actually beat its own benchmark. However, the S&P 500, a broader market index, returned a much stronger 6.20%. So while they did better than their specific real estate index, they lagged behind the overall stock market. What helped them outperform their real estate benchmark? Apparently, having a lot of money in telecommunications companies was a big factor. This sector did well because interest rates went down and the outlook for tower companies looked better. They also did well in healthcare, especially with a company called Welltower, which manages senior living facilities. Even some of the companies they didn't invest in, like Alexandria Real Estate Equities, helped their standing because those companies' stocks dropped. On the flip side, what hurt their performance? Not having enough in freestanding retail companies was a drag, because that sector did pretty well too. They also had some stock selection issues in what they call specialty REITs, particularly with a company called Iron Mountain. Apparently there were some worries that the government might go digital, which would affect Iron Mountain's business of storing records. Another company, EPR Properties, which is focused on entertainment, rallied, and since Cohen & Steers didn't have a stake in it, that also hurt their relative performance. Let's look at the top contributors to their performance. Telecommunications really shined, followed by healthcare and then office properties. But on the downside, freestanding retail, specialty real estate and timberland sectors were the main detractions from their performance. Now for the long-term picture. This table shows what would have happened if you invested $1 million back in 2015. Looking at the growth over the years gives us a real sense of performance. For instance, if you invested $1 million in 2015, by June 2025, your investment would have grown to about $2 nominal dollars. That's a decent return. However, compare that to the broader S&P 500 index, where that same $1 million would have turned into a much larger $3.59 million. So the story here is that while Cohen & Steers Institutional Realty Shares has grown your money, it hasn't kept pace with the overall market. Let's break this down by annual returns. For the last 5 years, Cohen & Steers delivered an average of 8.47% annually. The linked index managed 6.66% annually, so they're beating their specialized benchmark. But again, the S&P 500 averaged a hefty 16.64% annually over the same 5-year period. That's a significant difference, showing that sticking to a real estate focused fund might mean missing out on broader market gains. In terms of size, the fund has substantial net assets of over $7.7 billion. That's a lot of money being managed. They hold about 39 different investments, which is not a huge number. This hints at a more concentrated strategy. The portfolio turnover rate is 16%. This means they're not actively buying and selling stocks very often, suggesting a buy and hold approach for much of their portfolio. Let's see where their money is actually invested, the top 10 holdings. Welltower Inc. is their biggest bet, making up 10.8% of the fund. American Tower Corp. And Digital Realty Trust Inc. are also significant holdings at 8.3% and 8% respectively. These are all major players in the real estate investment world. Looking at the types of real estate sectors they invest in, telecommunications is their largest category at 18.2%. Healthcare is next at 14.1%, then data centers at 11.6%. And where are these investments located? Almost all of it, 98.7%, is in the United States, with a small sliver in other places. This indicates a very strong domestic focus. Moving into the financial operations for the 6 months ended June 30, 2025, dividend income was a healthy $118 million. The cost of managing this money, the investment management fees, was about $28.8 million. After expenses, they had a net investment income of around $89.4 million. On the investment side, they saw a net realized gain of about $70 million appreciation, meaning the value of their holdings went up by a substantial $188 million without them actually selling anything. This led to a total net realized and unrealized gain of nearly $259 million. All of this resulted in a net increase in the fund's net assets from operations of over $348 million. Looking at the changes in net assets, the fund had outflows from distributions to shareholders totaling $125.4 million. Scroll capital stock transactions, Scroll Casta. There was a net decrease in capital stock transactions of about $167.5 million. This means more money was pulled out of the fund through redemptions than was put in through new investments during this period. Overall, the net increase in the fund's net assets for the 6 months was about $55 million. Now, let's look at the per share data. The net asset value per share at the beginning of the 6 months was $47.91, cents, a modest increase. The total return for this 6-month period was 4.51%, as we saw earlier. Their expense ratio, which is the cost of managing the fund as a percentage of the assets, is pretty much stable at 0.75% after expense reductions. This is a reasonable fee for a specialized fund. Interestingly, the filing also includes a privacy notice. It basically says they collect your personal information to process transactions and maintain your account. They do share this information for their own business purposes, like marketing their products to you, but they claim they don't share with affiliates for marketing or with non-affiliates at all. Cohen and Steers Capital Management Inc. is the main manager, and they've got a fee structure that's the median compared to similar funds. They are also responsible for paying most of the fund's operating expenses, which is a good sign for shareholders, as it limits overall costs. The board reviewed and approved the investment management agreement. They looked at services provided, performance compared to peers, the cost of those services, and economies of scale. The fund outperformed its peers and its linked benchmark, which likely played a big role in the board's decision to continue the agreement. Alright, that's our breakdown of Cohen & Steers Institutional Realty Shares Inc.'s latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.